Welcome back to Smart Stock Sam, the channel built for traders and investors who want the real story behind the headlines, not just the hype. And today's story is a big one, because we are talking about why a massive move is coming for SoFi stock next week. And I am going to walk you through every piece of the puzzle that has led us here. We will break down the tug-of-war between SoFi's record fundamentals and the market's brutal sentiment. Dig into the explosive short seller allegations, see what the CEO is doing with his own money, and then pull back the curtain on the options data the big institutional players are watching right now. By the end of this video, you will know exactly which price levels matter most heading into next week. Let's get into it. Right now, SoFi is sitting in the middle of what I like to call the Fintech paradox. On one side of the scale, you have got an absolute fundamental peak. The company just posted record first-quarter profitability and is aggressively rolling out AI and blockchain products designed to capture the next wave of investors. But flip to the other side, and you find a brutal sentiment trough. The stock has swung through roughly 40% of volatility so far this year, hammered by its exclusion from the S&P 500 and a coordinated short seller attack that rattled investor confidence. This friction, a booming business colliding head-on with a terrified market, has created an incredibly tight, high-pressure window between June 15th and June 19th. Could this tension finally snap, and could SoFi stage one of those legendary overnight reversals traders talk about for years? The odds of that exact scenario are slim, but the setup is undeniably loaded. Something has to give, and we are about to see how this pressure has already started showing up on the charts. Let's look at the recent price action, because this is where the story gets interesting. In early June, SoFi was riding high, testing levels near $18.58. But sentiment can flip in a heartbeat, and a wave of macroeconomic fear combined with institutional selling triggered a sharp capitulation on June 10th, sending the stock crashing down to $15.87. That kind of intraday washout is brutal to watch live. But here is the twist. Instead of continuing to bleed lower, buyers stepped in fast and hard, defending that level and pushing the stock back up to its current close of $16.58. Was that bounce just random noise? Or could it be the footprint of smart money quietly building a position before a bigger move? I will let you draw your own conclusions, but that battle around the $16 level lines up perfectly with the bigger forces we are about to break down. Right now, that $16.58 price tag represents a tense equilibrium, caught between two opposing forces. On the bullish side, SoFi is giving its retail users early access to the highly anticipated $75 billion SpaceX IPO, an enormous user acquisition magnet for the platform. On top of that, the company rolled out SoFiUSD, a fully backed national bank issued stablecoin, alongside its brand new AI financial assistant, SoFi Coach. But gravity is pulling just as hard from the other direction. SoFi was passed over for inclusion in the S&P 500, meaning billions of dollars in automatic, passive institutional buying simply never materialized. And to make things tougher, sticky U.S. inflation sat at 4.2% in May, forcing the Federal Reserve to keep interest rates higher for longer, which tends to squeeze high-growth tech valuations. So here is the question. Could the SpaceX IPO buzz alone be powerful enough to override macro headwinds and rate pressure in a single week? It is a long shot, but exactly the kind of wildcard that keeps this stock interesting. And speaking of wildcards, none of this matters if we do not address the elephant in the room. We have to talk about the Muddy Waters short report, because this is where things got genuinely aggressive. The short seller publicly accused SoFi of using what they called Enron-esque accounting structures to manipulate its $12.9 billion loan portfolio, alleging the company hid $312 million in unrecorded debt to artificially inflate its adjusted EBITDA. These are serious, heavy allegations, the kind that can shake even loyal shareholders. In response, SoFi's management flatly denied the claims, reaffirmed strict compliance with standard GAAP and banking regulations, and confirmed they are actively exploring legal action against the short seller. So, where does that leave us? Retail sentiment has remained largely bullish and dismissive of the report, while institutional enthusiasm has cooled off as class action investigations get underway. Could this entire allegation collapse under its own weight and trigger a relief rally bigger than anyone expects? Possibly, though that outcome usually takes months, not days. Still, when a company gets hit with fraud allegations like this, the first thing professional investors look at is how the insiders react with their own money. There is an old Wall Street saying that insiders might sell their stock for a dozen reasons, but they only ever buy for one. In the days following the Muddy Waters attack, CEO Anthony Noto made his conviction crystal clear, stepping directly into the open market and buying the dip, scooping up 28,900 shares at roughly $17 each, putting $500,000 of his own cash on the line. And this was not a one-time thing. He had already purchased over 31,000 shares back in May. Together, that accounts for roughly 60% of all meaningful insider activity recently. To be fair, we did see some selling too. CTO Jeremy Rischel sold 94,000 shares for about $1,650,000, and a handful of directors made standard administrative tax-related sales. But here is the question worth sitting with. If the CEO truly believed those fraud allegations had merit, would he really be writing personal checks to buy more shares right now? It seems unlikely, and that kind of conviction often signals something bigger brewing beneath the surface, tied to a much larger transformation the company has quietly been building. Most people still picture SoFi as just a consumer app, somewhere you might refinance your student loans or buy a few shares of stock on your lunch break. But that view completely misses the bigger picture. SoFi is aggressively transforming into what I like to call the AWS of Fintech, a business-to-business financial operating system that quietly powers other institutions behind the scenes. They have been building this invisible infrastructure through a string of strategic acquisitions, picking up Peach Finance for cloud-native loan servicing, Primary Bid for unique access to capital markets, and Composer Securities for automated investing technology. In other words, SoFi does not just want your deposits and your loan business anymore. They want to power the back-end systems of countless other financial institutions across the industry. And if this B2B pivot keeps accelerating the way it has been, could SoFi eventually become one of the most important, least talked about infrastructure players in all of fintech? That is a multi-year story, but the early numbers already back it up. So let's strip away the noise and look at the cold, hard fundamentals for the first quarter of 2026, because the numbers are staggering. Adjusted net revenue came in at $1,090,000,000, up 41% compared to the same period last year. Even more impressive, net income exploded by 134%, landing at $166,700,000. But the real secret weapon, the one metric separating SoFi from a lot of fragile, unprofitable fintech names, is their deposit base. SoFi is sitting on $40.24 billion in customer deposits. Why does that matter so much? Because those deposits fund more than 90% of the company's liabilities. They are not relying on expensive Federal Reserve borrowing to fund their loan book. They are funding themselves through their own ecosystem, which lowers their cost of capital and protects their margins. With numbers like that, you would assume Wall Street analysts would be racing to raise price targets and upgrade the stock across the board, would not you? Well, as it turns out, that is not quite what is happening. Here is the disconnect that honestly surprised me. Despite record-breaking earnings, the current consensus rating from Wall Street analysts is an underwhelming hold. Barclays recently trimmed their price target down to $18, and Truist cut theirs to $17. Their main concern is that management chose not to raise full-year 2026 guidance, which spooked a few analysts even with strong quarterly results. But here is where it gets interesting. If you run the math on the broader 12-month consensus, the average target zone still sits between $20.87 and $22.56. With the stock currently trading around $16.58, that gap basically tells you that even cautious analysts believe this stock is undervalued at current levels, even while publicly telling retail investors to sit tight. So could we see a wave of upgrades the moment guidance gets revised upward later this year? It is possible, though Wall Street tends to move slowly on these things. Either way, fundamentals only tell you what to buy. To figure out when, we need to look at the charts. From a purely technical standpoint, things are looking surprisingly clean right now. Across the major moving averages, SoFi is flashing a definitive strong buy signal. The stock has reclaimed and is now trading above its 5-day, 50-day, and 200-day moving averages, a genuinely strong technical posture. The only real overhead resistance comes from the 100-day moving average sitting around $16.76. Looking at momentum, the 14-day RSI is currently sitting at 55.14, which puts it in healthy, neutral to bullish territory. In plain terms, there is still plenty of room for this stock to run higher before it becomes technically overbought. On top of that, both the MACD and the stochastic oscillator are confirming this buy signal. So could the charts alone be enough to trigger a breakout this week without any other catalyst? Technically possible, but charts rarely move in a vacuum, especially for a stock this controversial. To really understand where the smart money is positioning, we need to head straight into the options market. This is where the real battle is happening, the options chain for the June 18th expiry. Overall, the positioning is overwhelmingly bullish, with more than 350,000 contracts traded and a heavy skew of roughly 71% calls versus just 29% puts. But the strike prices tell an even more detailed story. There is a massive call wall at $20, backed by nearly 66,000 contracts of open interest, a significant magnet for price if momentum builds. But the real conflict zone, the line that could decide everything, sits right at $17. At that exact level, we have got roughly 35,000 call options going head-to-head against close to 27,000 put options. Meanwhile, on the downside, there is a substantial put wall at $15, acting almost like a concrete floor beneath the stock. So here's the question that should be keeping traders up at night. If SoFi manages to push through that $17 level with real volume, how fast could things accelerate from there? We will get into that exact mechanic in just a moment. But first, because this stock carries such a heavy short position, we need to address the question everyone keeps asking online. Is a massive, face-ripping short squeeze actually on the table for SoFi? At first glance, the setup looks tempting. Short interest sits at 14.74%, representing more than 186 million shares sold short, and roughly 40% of that activity is happening in off-exchange dark pools. On the surface, that sounds like a recipe for fireworks. But here's the reality check most retail traders overlook. The borrow fee, the cost short sellers pay to maintain their bearish positions, is sitting incredibly low, somewhere between 0.25% and 0.34%. That tells us shares remain extremely easy and cheap to borrow, the opposite of what you would see right before a true short squeeze. So the honest verdict is that a spontaneous, mathematically forced squeeze is highly unlikely, unless some major unexpected catalyst forces shorts into panic covering mode. Could that catalyst show up out of nowhere next week? It is not impossible, but it is far from the base case. So instead of betting everything on a fantasy squeeze, let's build a smarter framework for navigating both the short-term and long-term picture here. Here's the thing, you need two completely different radars depending on your time horizon with this stock. If you are a short-term swing trader, your eyes need to stay locked on that $17 call wall we just talked about. You will also want to track daily retail volume spikes connected to the SpaceX IPO access rollout and keep an eye on the off-exchange short volume ratio. If that dark pool percentage climbs above 50% while borrow fees start ticking upward at the same time, that is your signal something bigger might be brewing. For long-term holders, the daily noise basically does not matter. What you really want to watch is the technology platform revenue growth, which recently dipped by 27%, and the personal loan charge off rate, which has crept up to 3.03%. If SoFi can successfully cross-sell tools like SoFiUSD and the AI Coach Assistant to offset those rising risks, the long-term fundamental case actually points toward a $40 valuation by the year 2030. Could that kind of growth realistically happen on a much faster timeline than anyone expects? Almost certainly not, but it is still useful context for anyone thinking years ahead instead of just days. So let's bring this back to right now, because based on everything we have covered, this sets up as a genuinely actionable bullish swing trade for the week of June 15th through June 19th. The optimal entry zone sits between $16.35 and $16.50, ideally on intraday dips toward that 50-day moving average mentioned earlier. Your line in the sand, your primary support level, sits between $15.50 and $15.80, an area heavily reinforced by that 41,000 contract put wall. If price breaks clearly below $15.50, the entire bullish thesis is invalidated, and that is your signal to step aside. On the upside, immediate resistance is right at that $17 options battleground we discussed. But here is the real payoff scenario. If buyers manage to aggressively break through that $17 level, market makers may be forced into delta hedging, buying up shares to cover those in the money calls, which could create a rapid acceleration toward our upside target zone of $18.10 to $18.50. Is it guaranteed this exact scenario plays out perfectly next week? Of course not. Nothing in markets ever is, but the setup is undeniably compelling. So where does this leave us? SoFi remains a hyper-volatile, high-beta stock, caught in genuine crossfire between record-breaking fundamental execution on one side and serious macro and short seller scrutiny on the other. When you stack up the strong CEO insider buying, the powerful ecosystem deposit growth, and an options chain heavily skewed toward calls and practically begging for a breakout, the short-term setup looks tilted toward a sharp move above $17, while long-term investors have every reason to stay patient and watch those credit metrics. Before we wrap up, I want to remind everyone that this video is for educational and informational purposes only, and nothing in it should be taken as personal financial or investment advice. Markets are unpredictable. Stocks can move against even the best-looking setups, so please do your own research, consider your own risk tolerance, and talk to a licensed financial advisor before making any trading decisions. With that said, I want to hear from you. Drop a comment below and tell me this. If SoFi breaks through $17 next week, are you holding for the long-term story or taking quick profits on the swing? If this video helped you map out the week ahead, smash that like button, hit subscribe so you never miss a setup, and if you want to support the channel further, sending a super thanks goes a long way and means more than you know. And if you are serious about leveling up your trading and investing, come join our channel membership community where we go even deeper together. Thanks for watching Smart Stock Sam, and I will see you in the next one.